If you are avoiding Nigerian bank stocks because of the ongoing recapitalization, you might be making one of the biggest investing mistakes in 2026. While most people are panicking, analysts are projecting very strong dividend yields, rising earnings, and solid performance in 2026. The truth is that some Nigerian bank stocks are actually quietly setting up one of the most attractive opportunities, with analysts projecting up to 100% growth. In this video, I'm going to show you why analysts are optimistic about 2026, and I will show you which Nigerian bank stock is set for this exponential growth. So if you care about earning dividends, getting capital appreciation, and ultimately making smart investment decisions, you will want to watch this video to the end. My name is Funsho. I am a chartered accountant with over 14 years experience advising high net worth individuals and companies listed on the Nigerian stock market. I invite you to join this community by hitting the subscribe button and turning on the notifications so you will never miss my next video. Also, like this video and share it with your friends. In this video, I'm doing 4 main things. First, I will explain the Central Bank of Nigeria's recapitalization requirements. I will tell you what it is, I will show you the deadline and why it matters. Secondly, I will answer a big fear on everybody's mind. The fear that whether bank stocks will crash again like it did during the last recapitalization era. Third, I will show you what experts and analysts are saying about Nigerian bank stocks in 2026. And finally, I will break down the 4 Nigerian bank stocks that I'm going to discuss using their real numbers. I'll look at their current share price, I'll show you the dividend yields, return on equity, price earning ratio, and the share price projection. I'll also explain why all of these figures, all of these metrics actually matter in simple English. Note that this is not financial advice. This is for educational purposes so you can make better decisions. Let's start with the big elephant in the room. The central bank recently introduced a new recapitalization requirement for banks. In simple terms, the CBN is telling banks that if they want to keep operating at their current level, even their current level, they need to have more capital. Here is what that means. It means that banks with international license must now raise minimum share capital of 500 billion. National banks need to now have 200 billion as their minimum share capital, while regional banks need to keep 50 billion as their new minimum share capital. And the deadline for this was set at March 31st, 2026. Now pause here because this is where many investors panic. They hear recapitalization and immediately think of share dilution, rights issue, falling share price, and market crashes. And honestly, that fear comes from history. During the previous recapitalization era, many banks were not prepared. Some banks had weak balance sheets, while others had very high non-performing loans. But they were forced to raise capital urgently or merge with other banks just to survive. That created panic in the market and share prices dropped. Liquidity also dried up and investors' confidence got eroded. So the pain people remember now was not recapitalization itself, it was forced recapitalization under weak fundamentals. And this is where today is very different. This time around, something important happened. Most Tier 1 Nigerian banks prepared early. Before the deadline even got close at all, several banks had raised capital through rights issues. Majority of the big banks have already met or are very close to meeting the new requirements. This changes everything, right? Because recapitalization fear is strongest when deadline is close and banks are unprepared. But when banks comply early, the market shifts focus from fear to performance. And that's why analysts now describe this recapitalization as a sector upgrade and not a survival battle. Now, let's get into what analysts are actually saying right now. Analysts at Quadros Securities believe that Nigerian banking sector is set for a significant earnings uplift in 2026, supported by stronger capital buffers after recapitalization and improved asset yields and a healthier credit environment. The firm named GTCO as its top banking pick for 2026, citing superior earnings quality, strong capital buffer, and cost leadership. The firm also stated that GTCO is the only bank with a return on equity that exceeds its cost of equity. Another firm led by Mr. Tajuddin Olayinka believes that banking stocks are likely to rise strongly in 2026 despite recapitalization. The experts noted that while investors have been cautious, especially around dividend levels and regulatory clarity, banks with strong capital positions and clear strategic earnings growth driver are still likely to outperform. Before we continue, I want to quickly invite you to follow my WhatsApp channel. If you are serious about investing smartly, especially as a Nigerian investor, this is where I'll be sharing practical tips you won't always see here on YouTube. It's free and everything is focused on helping you make better financial decisions. If that sounds like something that you want, check the link in the channel description and join the channel now. I'm waiting for you to join before we start dishing out those very important information. Also, if you are here to subscribe and like this video, this is the perfect time for you to subscribe and like the video. Alright, now that we know what experts think about banking stocks, let us look at the actual bank stocks that you should buy in 2026. Let's start with UBA. UBA's current share price is 44 naira 50 kobo as at the date of making this video, and over the last year, the stock returned about 16%. Now, when analysts look at a bank like UBA, one of the first questions they ask is very simple. How much am I paying for each naira of profits in this bank? Right? That's what the PE ratio tells us. UBA trades at a relatively lower PE when you compare it to some of its peers in the Tier 1 group. That means that the market is pricing UBA conservatively. It's being priced like a steady, dependable business. Analysts have a target price of 53 naira 51 kobo, which implies roughly 20% growth from current levels. That tells us something important. Analysts are expecting growth, but they are not assuming miracles. They are assuming steady earnings improvements, not aggressive risk taking. Now let's talk about dividend, because this is where UBA really starts to make sense. UBA's dividend yield is 7.3%. So if you invested 100,000 naira in UBA, you would have earned roughly 7,300 a year in cash. That's real money into your bank account, not something that only exists on paper. But professionals don't stop there. They also ask, how efficiently is this bank using shareholders' money? That's where returns on equity comes in. UBA's ROE is solid, but not extreme, and that's actually a good thing. It tells us that the bank is profitable, but is not overstretching its balance sheet just to boost returns. Now, add in UBA's Pan-African operations. Because UBA earns monies across African countries, it benefits from geographic diversification and foreign currency income. So when one economy slows down or faces FX pressure, others can help balance this up. Put all that together and UBA starts to look like what professional calls a resilient stock. It's reasonably priced, income paying, and diversified. Now let's move to Zenith Bank. Zenith Bank's share price is around 71 naira, and over the past year, the stock returned roughly 39%. That already tells us something. The market has rewarded Zenith Bank for its fundamentals. Analysts see a target price of 82 naira 52 kobo, and this implies 16% upside from now. Not massive, but still meaningful. But again, professionals don't look at price targets in isolation. Zenith Bank trades at a higher PE than UBA, and that's intentional. Investors are willing to pay a bit more for Zenith because they trust its earning quality. This is because Zenith is known for predictable profits, conservative lending, and strong risk control. Its dividend yield is about 7.4%, which means you are getting paid generously while holding a high quality bank. Now let's talk on returns on equity, because this is where Zenith Bank really shines. Zenith Bank generates a high return on equity without taking excessive lending risk. In simple terms, it squeezes more profits out of every naira of shareholder capital, and that's why analysts often describe Zenith Bank as a dividend machine. Its strong ROE comes from its operational efficiency, disciplined lending, and a clean loan book, and not from chasing risky growth. For income-focused investors, this is exactly the kind of stock you want to be holding in your portfolio. If you are getting value from this video, don't forget to like the video and subscribe to the channel so you can see more valuable videos like this from me in future. Now let's talk about GTCO. GTCO's share price is around 98 naira 50 kobo as at the date of making this video, and it delivered a strong 58% return over the last year. Analysts have a target price of 105 naira 37 kobo. As at the first glance, that might look like limited growth, and this is where a lot of beginners get confused. Experienced investors don't look at increase in stock price alone, they also look at total return. GTCO's dividend yield is about 8.2%. That's the highest among the banks we are discussing today. That means that even if the share price moves slowly, you are still earning meaningful cash every year. Now, from a valuation standpoint, GTCO's PE sits somewhere in the middle, not cheap, not expensive. That tells us that the market is pricing GTCO fairly, but returns on equity is where GTCO really stands out. GTCO generates a high returns on equity because it runs efficiently. It invests in digital banking, payments, and platforms which keep costs low and margins healthy. GTCO doesn't need to take big risks to make good money. That's why analysts like it so much for total returns and strong dividends. Finally, let's look at Stanbic IBTC. Stanbic IBTC share price is around 108 naira after an incredible 80% return on over the past year. Analyst target price is around 107.56, which is basically telling us that the stock is trading close to its fair value. Now, here's an important lesson. A higher PE doesn't automatically mean a stock is expensive. Sometimes it simply means market expects strong future growth for that asset. Stanbic's earnings are forecasted to grow by about 24%. That's the highest among these banks. So that means that investors are willing to pay more today for profits they expect tomorrow. Now look at returns on equity. Stanbic's ROE is strong, but what really matters is how it is generated. A large portion comes from asset management, pensions, and wealth services. These businesses are capital light and scalable. That means less credit risk, less balance sheet stress, and more predictable earnings. Stanbic's dividend yield is lower at 5.1%, but that's a trade-off. The bank reinvests more into growth rather than paying everything else today. Stanbic is for investors who care more about long-term compounding than immediate income. So here is the big takeaway. PE tells you what the market expects. ROU tells you how well management uses your money. Dividends tell you what you get paid right now. No single number gives you the full picture, and that's why UBA stands out as a fairly priced bank with good diversification. Zenith delivers stability and dividend reliability. GTCO offers one of the strongest total return profiles, and Stanbic leads on growth and scalability. Investing is not about finding the best stock. It's about understanding what you are paying for and why you are paying. So if you found this video helpful, don't forget to like the video and subscribe so you get to see more valuable videos like this from me in future. Also drop your comments below. Let me know which Nigerian bank stock are you really watching out for in 2026. Thank you for watching, and I will see you in the next one. Please watch the next video on the screen.